Financial Planner, presented by the Bombay Stock Exchange, IPF.
Hello and welcome to this episode of Financial Planner. Well, in the last episode, we left you with making you understand about different kinds of, mutual funds, whether it was based on objectives, whether it's about the tenor. But this time around, we'll go a little deeper into understanding various categories based on the asset allocation and asset classes of mutual funds. And joining me to help you understand that is Jayant Pai from Parag Parikh Financial. Thank you, Jayant, for joining us. You know, we've spoken and laid it down that, there are active funds, there are passive funds, there are, other categories in terms of tenor, which is open-ended or close-ended, but all these funds are a part of different asset classes or investment objectives, if I, stand correct, right?
Yeah, that's true. These categories that you mentioned are across equity and debt.
Across equity and debt funds. Now let us go back in terms of the asset classes. Now as far as the equity funds are concerned, clearly defines as a fund which is investing its money in equity, right?
Yeah.
Now two questions that I have. One is that when you look at it, there are large cap, mid cap, small cap, etc. That also comes as a category. And if we are saying equity funds, does that mean that the fund is completely equity, or it may have major portion in equity?
Yeah, see, most of these classifications, like what you said, the large cap, mid cap are based on the market cap that the fund invests in. Other than that, whenever the fund submits itself to SEBI for approval, they have to state the investment mandate. So as per the investment mandate, they will have to invest in that particular asset class up to a certain percentage. They cannot go below that. So equity funds normally invest at least 80 to 85% in equities. Now within equities, it could be either large cap, mid cap, or whatever. On the other hand, there are certain other categories such as balanced funds, which have a combination of debt and equity, but there the equity proportion could be lower. So it depends on the investment mandate.
Okay, so basically, but when you're talking about the growth and equity fund, as it is commonly referred to, when a particular fund house is writing to SEBI or giving the proposal that this is what my fund is going to look like, this is my investment objective is, it can be that it can say I'm investing 100% in equity, or I can say that, or the fund house can say I'm investing about 80 to 90% in equity. Is that what you're saying?
Yeah, there are certain broad ceilings and floors. So, and within that, no fund will ever commit to 100% equity, because they usually require some cash balance to meet redemptions, because otherwise they will be forced to sell stocks to meet redemptions. So SEBI permits them to hold cash, either cash per se or money market instruments up to a certain percentage. Say usually it is around 10 to 15%. That funds do, because beyond that the fund could suffer from a phenomenon known as cash drag. Cash drag refers to you not being able to participate in the markets because of holding an inordinate amount of cash.
Okay, so now as we said that investment objective is already defined when you're putting in the or sending the proposal to SEBI, so to say. Balanced fund, when we're talking about, and you referred to it, is a combination of equity and debt.
Yes.
So it can have an option where the equity component is higher, or it can have an option when the debt component is higher. Is that correct?
Yeah, they are given certain greater latitude as compared to hardcore equity funds. At the same time, certain other considerations will compel them to be in equity or debt. For instance, equity oriented balanced funds must have at least 65% of their assets in equity in order to avail of certain tax benefits.
Okay.
So like for example, only such funds, the investors within such funds can avail of a long-term tax benefit of 0, if they hold on for a period of 1 year. If the fund is below that threshold of 65%, investors will have to pay tax as per what they would have to do if they had owned a debt fund.
So it's essentially interesting that the tax, application or implementation of tax defines what really the category is. Because if equity fund would necessarily, for it to enjoy the benefits, tax benefits that equity funds would, it has to have 65% of minimum equity in it, right?
Yeah, that's right. So, but this is more pronounced in case of a balanced fund, because in equity funds anyway it's over 80%. So that thing is not invoked. But in balanced funds it could be a big issue, because investors should be
whether it will be a debt related instrument or a equity instrument. The tax component, how is it calculated?
Yeah, so that's how many of the research houses, they classify balanced funds into two. One is equity oriented balanced funds, that is which own over 65%, and debt oriented, usually ones which hold below 65. So theoretically balanced funds is 50-50, but in reality it's not so.
Okay, in reality it's not so. Now coming back to another thing which is called the liquid funds or the money market funds. Essentially these are the funds which are for extremely short period of time. And as a retail investor, while liquid funds is where the banks and the corporates park in their money to earn that interest, which they get better in terms of tax wise, it's a better option than say a fixed deposit. A liquid fund essentially for retail investment could be used if you have a lump sum, put it in liquid fund, and then through a systematic transfer plan look at investing in an equity or whatever fund that you may choose. Now that perhaps may be a little jargon that I have thrown upon to you, but Jayant, if you could explain to them in very simple words what really is liquid funds and how as a retail investor it can be in your portfolio.
Actually, as you very rightly mentioned, liquid funds are a corporate product, because corporates prefer to park their money there as compared to FDs. But for the past couple of months, even that tax arbitrage has been nullified. So right now all debt funds that corporates invest in will attract a 28% tax as compared to the old 14%. So the attractiveness of liquid funds even for corporates are reduced. For retail investors anyway, liquid funds was not such a preferred product, because they would have to pay tax at around 28%. So unless you are in the highest tax slab, all people in lower tax slabs would not have benefited much. But certainly it's a good vehicle for undertaking STPs, that is systematic transfer plans, simply because the exit load in most of these funds is zero. So suppose you initiate an STP of a figure of say 5,000 every month, you could park say 60,000 in a liquid fund and then do 12 installments of 5,000 each into an equity fund of the same fund house. So that's a good option.
That is where liquid funds for retail investors will come. Yeah,
that is, I feel that is the only reason why they should be into liquid funds. Otherwise there are other funds which are in the risk return spectrum. There are other debt funds, for example ultra short term income, which we may cover later on. So they are actually more suited for retail investors.
Okay, as Jayant was mentioning, we've discussed the equity funds, then there are debt funds which basically invest in debt instruments and help you have a sort of a secured return in that sense.
Again, see, mutual funds, there is no guaranteed return in the first place.
Relatively secured?
Compared to equity, yes. Compared to equity, yes, simply because the volatility of returns is lower. So, but again, you could lose money in the short term, even in debt funds. It has happened.
Okay. So, as Jayant is saying, you could lose money in debt funds, but if you don't want to take a risk of that equity funds offer or a limited risk, so you look at a debt profile. Now, as far as liquid funds are concerned, and as I had already sort of mentioned to you before, liquid funds, and if you remember that last week we discussed about systematic investment plan, that is investing regularly. Now, if you have a lump sum money, money that say you've got a bonus or anything, and you still want to invest in a systematic fashion, then a liquid fund comes into play. Liquid funds essentially are the vehicles where corporates and banks etc. used to park money to earn a certain level of interest, which is more tax efficient as compared to a fixed deposit. So you put in a little bit of money in liquid funds if you have a lump sum, and then through STP, as Jayant mentioned, it's a systematic transfer withdrawal. So the benefit of SIP, that monthly from your bank account a certain money goes into that fund. Through STP also, it's on a month-on-month basis, you can park in certain money into a particular fund that you choose. So you also, it's a way of getting an SIP so into place. So that's where liquid funds come into play. Now the next part is the gilt fund. What is really a gilt fund? It's a part of the debt category, or it is to be treated separately?
No, it is the other extreme of the debt category. Liquid is one extreme, and gilt funds are funds which invest only in central government securities. So in that context, they are very safe because you will not have any default risk, because no central government has defaulted in India at least.
And you need to have it for a longer period of time.
Yeah, so the average maturity of these schemes of course are open-ended, but the maturity of the holdings within, that is usually for long periods, say 7 to 10 years, that will be the average. So consequently they are more prone to this thing known as interest rate risk, because mutual fund NAVs move opposite to what the interest rate cycle is. So in case of gilt funds, the NAV will move up only when the interest rates are falling. So these products are popular during falling interest rate regimes, and currently we are in a rising rate regime. So these are extremely unpopular. If you see the assets in these funds, they are very minuscule, because people do not want to be in this, because the NAV loses value every time there is an interest rate hike announced by the RBI.
Okay, all right. Now another fund category that is there, which are called specific or sectoral funds. Now generally this is for the equity funds category, it's a part of that, but what happens is that, like in investment objective that has been put across to SEBI or the fund, what the investment objective it is, it can say it is investing in an FMCG category, it can invest in an infrastructure category, or it can invest in banking category. What does that mean? Basically they sort of give an idea that they will be investing in this particular sector or category. Now an important point here, Jayant, is that you should get sector allocation only once you're completely diversified. Is that correct? Or is it a case also that, say, suppose you've started investing at the age of 22, you can take higher risk and therefore you can go for a sectoral sort of theme. What is your opinion?
Yeah, I mean irrespective of age, but the main thing is that all sector funds, there are two things, sector and thematic. Both these categories of funds carry concentration risk, because as per their mandate, they have to invest only in that sector. For example, a banking fund cannot invest in FMCG stock. On the other hand, the regular diversified funds can go anywhere. So if you choose a sector fund, there has to be a very strong rationale why you have chosen that. So either you are very positive on the sector, or you know something more about the sector than what others do. So that is one thing, but unfortunately what happens, people flock to sector funds at a time when the sector itself is popular.
So therefore they get into it.
During such times, a regular mutual fund will also have a lot of stocks of that sector. So it's a duplication.
Alright, Jayant, well, on that note we'll just take a short break, because we're really running out of time, but we'll be continuing this discussion about various thematic funds and other funds category, and that will something that we will be following up in Financial Planner. We'll take a short break. We'll be back soon.
The Financial Planner, presented by the Bombay Stock Exchange, IPF.
Well, Jayant, we have a query from Mr. Sunil Sharma from Solan. He is basically a 26-year-old. He's single. He's a government employee and has about 15,000 rupees per month salary in hand is what he gets. He's just started an SIP mutual fund, and his objective is wealth creation for retirement is his focus area, and he just wants to know, he's already done some investments and he wants to know whether he's done right or taken a good choice. Basically he's invested about 1,000 rupees per month in Reliance Banking Fund, because he believes that banking sector has been doing very well. He's also in ICICI Pru Discovery Fund, he's in Reliance Gold Savings, HDFC Prudence, and what he says is that he wants to create wealth as much as possible through the banking fund and Pru Discovery Fund. These are the categories for which he has a 15-year horizon. But however, he wants some constant return for some requirements or some goals that he has for about 1 to 2 years, which are the goals that within 1 to 2 years is when he needs it, and it is from Reliance Gold and HDFC Prudent, and he wants to know whether he's on a right track. Now, one thing which is there in this entire issue is with regard to that, while he has goals set, he has set the goals with regard to certain funds. Is that the way that one should go about?
Yeah, surely funds can meet a variety of goals, whether they are short term in his case of 1 or 2 years, or even a 15-year goal. There are several funds, but unfortunately the kind of funds he has chosen are not really the best fit. For instance, the gold and the HDFC Prudence. Prudence is an aggressive balanced fund which has over 70% into equities.
Okay.
So, you know, over a 1 to 2 year time frame, it is very likely that in case he suffers a loss, he will not have enough time to recoup it. So, for his case, I would not suggest Prudence, or see, even a gold savings fund. No doubt gold is less volatile, but given the fact that it has had a stellar run for the last few years, it is very likely that it may go into a slumber for the next 2 years. So nobody knows that. So these type of funds are not the best to meet a 1 and 2 year time frame. I would suggest a simple fixed deposit or even an ultra short term debt fund for this purpose. For the 15-year time frame, he has chosen some funds which are well performing, but again, see, we have a concept called core and satellite. Whenever you construct a portfolio, you should have a certain good foundation, and over that you can build up other things. So these type of funds, banking and discovery, are more of the icing on the cake, but the foundation itself is not very strong. So I suggest that he stop his investments in both these and replace it with, in case of ICICI, he could choose ICICI Focus Blue Chip, which is a large cap fund from the same fund house. For the other thing, he could use either a DSP equity fund or a Fidelity equity fund or a Franklin Blue Chip. See, these are funds which, one, they are more large cap oriented. Second is they are go anywhere. So the fund manager has the discretion to invest in things based on their judgment, which both these schemes don't have, because ICICI Discovery is a pure value fund. So they will have to go into beaten down stocks, and banking, of course, is restricted by its mandate. So in both these cases, I don't think he should invest further. He could do in this once he has a good base later on, as he earns more. Right now his savings ratio is pretty good at 20%, but as he earns more, he should save more, say up to 30-35%. Then maybe 5 to 7% can be into such funds, but not right now. And also the kind of both these schemes that he has invested in, I would suggest that he not immediately sell it, because it may attract exit loads and capital gains tax. He should hold on for 1 year from the time he stops today. So in say July 2012, he should withdraw this amount and then invest further. But all further SIPs should be done into funds which are more regular diversified funds.
So basically he ends the SIP right now and then hold on and not take out the money for at least a year, and put that SIP which he was investing in, say, Reliance Banking and the Discovery Fund, in another fund category.
Into whatever he is doing now, he can add on. Like if he invests in, say, Focus Blue Chip today and say a Fidelity Equity. So in 2012, he can withdraw money from these two existing funds and merely add to that. There's no need to keep on adding more funds.
Okay.
So that's how I would suggest.
So basically, the existing funds, you think was that while the strategy may be correct in terms of allocating one particular fund for one particular goal, and so on and so forth, but the funds that he has chosen is not really correct to meet those goals. Yeah,
that's what I feel.
In terms of the aggressive balance fund that he has picked up and so on and so forth.
Investment Ladder, presented by the Bombay Stock Exchange, IPF.
Well, as Jayant right now said, Sunil, that, as far as your current funds are concerned, the important point is here that for a 15-year horizon that you're looking at, the funds that you're taking is something that you can have in your portfolio, but when you have all the foundation strong, that is, you have got funds which have been long performing, a diversified fund, a long, a fund which is, in good stocks, etc. So now what Jayant is suggesting is that you may stop the SIP currently in these two funds and perhaps look at other funds which he has given you in the reference that he has given, the SIP, but as far as getting the cash or the money that you've earned so far back, hold on till 1 year, which will be more good as far as your tax is concerned. Well, on that note, we'll take a short break. We'll be back in just a bit to bust some terms.
The Financial Planner, presented by the Bombay Stock Exchange, IPF.
Welcome back to Financial Planner. It's time to bust some terms, and one of the terms that we're busting today is basically one of the mutual funds category. FOF is something that it's called funds of funds. So what are funds of funds, Jayant?
So as the name suggests, they'll take money from you, and this scheme will collect a corpus and immediately invest it in some other fund. So there is no active fund management in that sense. So this fund may be from within the same fund house. And you have cases from the Franklin Templeton stable, for example, Franklin Life Stage Fund of Funds, which invest in, say, Blue Chip, Prima, Templeton India Growth Fund, and a couple of other debt funds. You may have also a fund of funds investing in other fund houses. For instance, Quantum does that, where the Quantum Fund of Funds has invested in HDFC, Birla, DSP. So these are the two variants of fund of funds.
Why would anyone be interested in investing in a fund of fund and not directly in a fund, unless a lot of fund of funds also invest, say they, for example, I think the DSP-BR World Gold Mining Fund, it takes the money from us as, you know, Indian residents and invest in the global fund, which is the, you know, so basically allowing us to access the global fund.
Yes.
So what happens, you know, otherwise in a domestic fund of fund, what difference in the tax treatment quickly? We don't have much time.
So one is the international thing that you mentioned. Otherwise, fund of funds gives you a varied exposure within one instrument. So that is true, but tax treatment is unfriendly because one is a higher expense ratio of 0.75% you'll have to bear with this, as well as these fund of funds are treated as debt funds. So there's no zero long-term capital gains tax. Even if you're investing 100% in equity funds, you'll still have to pay 10% or 20%, whatever rules are there for debt funds. You'll have to pay that. So actually this is not such a great product so far in India. It's not caught on much also.
Well, that's what fund of fund is, because we have dedicated this show in terms of, you know, making you understand different categories, but it has not ended here. So we'll be continuing with making you understand more about different mutual funds category when we return in our next show. Thank you for watching till now.
The Financial Planner, presented by the Bombay Stock Exchange, IPF.